Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day, all. Ira Epstein of Linn Associates with your agriculture update, and I'm late today, and that's why the boards are all cleared behind me. It's just been so volatile. I was doing television shows, interviews, because of the volatility. It's just plain crazy. So let me take you right to a chart. The soybean weekly area chart of closes has not been able to close back under that 18-week moving average, which keeps it in an upside bias. And very frankly, today's close at 986.25 is the highest close since you bottomed out at the 947 level. When we come to a daily area chart of closes, not the weekly, yesterday you had gotten and closed down here at 969. You had, if you will, thrown the market into downside bias because you closed under that number. And today, when the stock market recovered, and that took a lot of pressure off a lot of areas, we saw this market come back up, settled 986.25, well over that 980 level. So what we've got is a market that fell back, tested a support zone, held it, and is trying to rally again. When we see this on the daily bar chart with nothing on it, you can see the wildness of today's action. Yes, we started off feeling the pressure of the stock market. Remember, that stock market last night was down 600 points. I remember going to bed and I'm going, I have no idea what I'm going to wake up to in the morning, but my guess is it'll recover something because of the massive declines that you'd had. But the rest of the world's pressure had to first get it. And if you think that that doesn't pressure commodities, wrong, wrong. If people get caught in one area in a big way, they start liquidating in other areas for cash, for fear. They don't want to be involved. When things clear out, they seem to come back very quickly, grabbing positions. And my guess is that to a degree, that's what happened in the soybeans today. That's why it's such a big day. I mean, if you look at the range, it's a 20-cent range on a day like today. Did it change anything on the chart? Yes and no. You still have the higher high and the lower and low. That's why I've got the arrow showing that's the low. So you got the lower and low and you got the higher high. You're not trending. That's the first thing. Where's the 18-day average of closes? Well, you closed under it yesterday. The day before, you'd settled right on it. You came back up. And what was acting as support, and I'll show you that right through here. I think you'd agree the 100-day average was acting as somewhat support. The first move over it often fails. Just keep that in the back of your mind as a rule of thumb. Doesn't mean it can't come back over it again. And that next time it gets stronger and stronger. Then the market's believing that it can stay over that number. Fell back, hit the 18-day average on Thursday of last week, held it. Held it again on Friday. And then as the market let go yesterday, markets went with it. And they carried through early this morning, and now it's come back. So the resistance number becomes what? The old support number. That's how it typically works out. What about momentum from the upper and lower Bollinger Band? Because of this move and the way that the math moves, you've widened everything out, and I'm going to use the word they're not in play. They're not in play because they're so far away, that's all. You'd have to move 20 cents higher to hit the upper band, and from the lower band today, you'd have to move almost 20 cents lower from the low. From where you're at right now to get to it, you'd have to move 30-some-odd cents lower. So I'm going to say the market's more or less working in this general scope. When I look at momentum, the downside momentum has abated, and you see that obviously with the big swing up today. When we come to the meal market, same type of thing. The 18-day average has become the key. It was not weak enough to get to the 100-day and certainly got nowhere near the lower Bollinger Band. The trend had been down, but now that the market is closed, we can see it is still down because you closed underneath the 18-day average. That number is 331.80 to right here. The bears they'll probably try to defend their position here, but if you get over 330, 430, they'll realize very quickly you've got a lower low and a higher high, and that phase of the downside is over. It doesn't mean we've started an upside. If you don't take that out and you drop back, the bears still have the control in the market. In the soybean oil market, remember what I told you, this market just looks at either side of what beans and meal are doing, and it's generally the one that's abandoned. Well, it got lower, then higher. You have an outside day up. I'm going to look for stiff resistance at the upper Bollinger Band. Momentum is up, bias is up, but you're not trending. You've again got a higher high and a lower low. The corn is doing what? Well, first off, on the swing line, it's not trending, but it is doing what? It's paying 100% attention to the locked-in momentum off this number. All it did is pull back to the 100-day average, take off. The resistance is at the upper Bollinger Band at this point. The bulls are in control. In the wheat market is an overbought market that's falling back into the first support at the 100-day average. If this gives ground, then the 18-day average becomes the next support. Even if the market takes out 451, this rally high, you'd still have a lower low and a higher high. I'd call this market mixed. Sugar market still, in my opinion, has the swing line to the upside, price momentum up, formidable resistance between the Bollinger Band and the 100-day average, support back at 1351, the 18-day average, but it's overbought, very overbought. So it's used a lot of this sideways action in coming up and spent its strength. That doesn't mean it can't go higher, but overbought conditions either embed or they correct by coming back down or going sideways. So unless it's going to embed, the market's spending its energy. Coffee market went right to my numbers. Take a look at today's low, 119.10. If you look at these other numbers, 119.50, you had not hit the lower Bollinger Band. You were so close and oversold. I probably said yesterday, if you were watching, or certainly in my videos, I'll bet this is where the shorts are covering. Go right through it, come up dramatically 300 points. So the bears got out is what I'm saying, and I think the market is just neutral right here. Cocoa still has a bid. It's still a strong market. If we take a look at the slow stochastic reading, both numbers are over 80 today. They were both over 80 yesterday, but they were not the day before. So what we have is an overbought condition that could embed. It's into a resistance point. It's found its way between the 100-day average and the upper Bollinger Band. The bias is up and the trend is up. Problem is the market either embeds here or it's overdue to pull back on you. In the cotton market has suddenly become a market that is number one, both numbers under 20, both under 20, but not the day before. Tomorrow's the do or die day. Is it going to embed or is it going to get its bounce from here? The bears are in control. I would think that the bears are covering here, not waiting to see if it embeds or not, and they'll come in again and chase it if they have to. In the cattle market, you have divergence all of a sudden. Why? Momentum is turned down. You still have the higher lows, higher highs, and the bias up. The bulls have to defend their position in this general area. If they let it go under 122.50, this leg of an uptrend is all over. So they still have control, but I don't like when I see divergence. Feeder cattle, same thing. Feeder cattle got up to the upper Bollinger Band. Outside day down yesterday, follow through. What was resistance, the 100-day average, which you had hit, is logically probably the first support. Again, what I don't like on a chart is the divergence. Once you start turning that momentum down, you're back into an overbought condition. In the hog market, you closed at 71.42, just under the lower Bollinger Band. You have the higher high, lower low pattern in an oversold condition. Not saying you can't go lower, but unless you embed, the odds favor the markets in an area where it can get a bounce on you. I want to remind you, market research, our market research. We specialize, we're a commodity firm that specializes in the old-fashioned thing. We write reports, we do videos, we hold hands, we talk to our clients. We're certainly not the big firms today that are Interactive Broker, firms like that, where you trade on your own, you do your own thing. Great firms if that's what you want. You come to a firm like ours, yes, you can be self-directed, and we offer very competitive commissions. But to get our niche, we write, and we provide a lot of hands-on. I mean, you talk to a margin clerks, and we have several. At times of the day, we're rotating, but we have people on desks. You get to know them. You can talk to them. It's the old way of doing business. Does it suit everybody? No. But if you look at my hair, and I'm an old way guy. In any case, we write for the commodity guy. We're writing about the options. We're writing about spread strategies, be it the soft markets, the grain markets, the meats. We don't expect you to want all these categories. You can pick and choose. As a client, you're picking and choosing, and you're looking forward to that information throughout the day and night. We have a whole staff that's filling you in on that. So it's commodities for commodity people. What else? Well, if you haven't seen it, we want you to. We want you to see what the research looks like. Research in the commodity game isn't as easy to find as you think. It's easy to get an opinion. It's very difficult to get quality research. So I'm saying quality. All you got to do is take a free look at it, and you make up your own mind. Give us a call. You can go to our website, take a look at it there. In other words, you won't see it on the website. You can sign up for it, and then we'll start sending it to your email box. You can click here, take you to the form area, or underneath us it says, click here for Ira's free information. I'm Ira Epstein. You have a good day, and I'll talk to you tomorrow.